Good afternoon. I'm David Luberoff, the Deputy Director of the Joint Center for Housing, and it's my pleasure to welcome you to our Housing Research Seminar. One brief announcement. This is the next to last in the spring semester of the Housing Research Seminar. We'll be back next Friday with Erica Mosikowski, a PhD candidate in business economics, who is also one of our Meyer dissertation fellows, and she will be speaking about, can retail vacancy taxes reduce storefront vacancies? Eric's been doing some really interesting research about the causes of retail vacancies, specifically in New York City, and what the impacts would be of a proposed vacancy tax. And that will also touch on how retail vacancies and the possible tax may affect housing values and rents in New York City. So really interesting topic, one that I know lots of folks around the country are interested in, but that is not today's presentation. Today, I'm really thrilled that Adam Travis, a PhD candidate in social policy, who is also a Meyer dissertation fellow, will be speaking about some really interesting research, and I believe this may be the first time he's spoken publicly about it. So think of this a little bit as a work in progress seminar, and looking forward to questions. Adam's going to be talking about assessing the landscape of corporate ownership for small rental properties. And this is a subject that has really garnered a huge amount of interest in the last 6 months to a year. There have been several articles in the Wall Street Journal and the Washington Post, among other places. It was a topic of some conversation in the recent symposium we did on digitalization. Adam, as has been the case in the several years that I've known him, was ahead of the curve and identified this as a really interesting issue a few years ago. So he's going to be presenting some terrific research, as he'll explain, draws a lot primarily on data from 2018. So it's not going to pick up this last blip, but is already picking up on a really important trend. As I said, this is work in progress. This will be in his dissertation, and I suspect in continued research. We've known Adam for many years. He first came to our attention in a different project we funded on the rise of LLCs, which I think he'll talk about. So we're really excited to welcome Adam to the Housing Research Seminar. Adam's going to talk for about 35 minutes. That'll leave us about 15 or 20 minutes for questions that we'll curate from the Q&A, which we greatly encourage you to use. This is really helpful. Apologies in advance if we don't get to your questions. I suspect we're going to have many more questions than we have time to answer. We will download the full transcript of questions, and if there's some things in particular that need to be followed up, Adam will follow up with you. But without further ado, Adam, it's all yours. I'm really looking forward to this.
Great, thanks, David. Let me just get my slides up here. All right, great. So hopefully those came up all right. So thanks, David, for that kind introduction, and to everyone at the Joint Center for the opportunity to share some of my research here today. As David mentioned, I'll be presenting work from my PhD dissertation, which sort of broadly explores a number of ongoing changes to the way that rental housing is owned in the United States, focusing in particular on small rental properties and the characteristics of landlords who own them. The part of the dissertation that I'm going to focus on today really describes what I call sort of the legal landscape of rental property ownership. And I'm going to focus in particular on the manner in which small rental properties have increasingly come to be owned by business entities and shell companies rather than directly by individuals. Now, as David mentioned, this talk is titled The Landscape of Corporate Ownership. But for reasons I'll sort of return to at moments through the talk, I'm going to try to be careful about how I use the term sort of corporate landlord or corporate ownership. And a big part of this has to do with the fact that for many of us, certainly for myself, the corporate label can really almost automatically evoke a sense of organizational scale or of bigness. And part of what I'm going to try to argue today is that, in fact, in order to more fully understand sort of emerging patterns of what we might think of as corporate ownership, we actually really need to attend carefully to the activity of small and mid-sized landlords who may operate using corporate legal structures despite exhibiting few other corporate characteristics. I'll also just add, as David mentioned before diving in, that this is still very much work in progress. So I'm very grateful for comments and suggestions in addition to your questions, and I'll be sure to leave my contact information up on the last slide. It's also right here on the title slide. All right. So where are we headed? I'm going to start with sort of a fairly straightforward empirical puzzle and use that puzzle to motivate what I think are two fairly straightforward descriptive questions. I'll then provide a little bit of extra background for this study, drawing on some previous work that David mentioned on limited liability companies. I'll give an overview of some of the administrative data that I'm using before sharing a few key findings. And I'll wrap with a summary of what I think we do and don't learn from this analysis, as well as some potential implications for future research and policy. So this very simple bar chart really gets to the core of today's talk and a big chunk of my dissertation more broadly. So using data from the 1991 Residential Finance Survey and the 2018 Rental Housing Finance Survey, this figure compares the share of small rental properties owned by a business entity in 1990 and 2018. So in these data, by business entity, I mean any rental property that was owned by a corporation, a limited liability company, a limited partnership, or a real estate investment trust. And what we see here is that in 2018, about 18% of small rental properties were owned by a business entity, up from only about 3% in 1990, so a fairly sizable increase. And so a big part of what I'm going to ask is, how should we make sense of this change? Now, if you're like me, one place that your mind might immediately go as you start thinking about corporate ownership of rental housing is Wall Street. And many of you may now be familiar with the fairly well-documented entrance of large-scale financial firms into single-family rental housing markets in the aftermath of the foreclosure crisis. So the largest firms established by these institutional investors, companies like American Homes for Rent, Invitation Homes, and Tricon Residential, acquired tens of thousands of rental properties across select US metros. And thanks to a really terrific body of growing research by scholars like Desiree Fields, Dan Immergluck, Suzanne Charles, Eric Seymour, Alora Raymond, and many others, we've really come to know a great deal about the activity of these firms and the factors that contributed to their emergence. So, for example, we know that the presence of a tight credit market in the aftermath of the foreclosure crisis gave a huge advantage to financial firms with direct access to investor capital. And we also know that new developments in real estate technology made it easier than ever for these firms to acquire and manage large scattered site portfolios of single-family rentals. Excuse me. And of course, the foreclosure crisis itself also generated large supplies of single-family homes that could be acquired in large volumes at affordable prices. And we also know that these firms tended to be quite strategic about where they concentrated their acquisition activity. So in particular, these firms tended to target Sunbelt metros characterized by strong population growth, affordably priced housing, and comparatively newer housing stocks. And even within these metros, institutionally scaled investors tended to concentrate their holdings in more affordably priced middle-class suburbs, especially in areas that had been hard hit by the foreclosure crisis and, not coincidentally, were often home to larger shares of Black and Hispanic residents. And we further know that these largest institutional investors often employ a distinctive set of practices around eviction filing, rent setting, and the imposition of supplemental fees that can often have harmful effects for tenants. But here's something else that we also already know about institutionally scaled investors. Despite their huge size and considerable presence in select markets, these investors only own between 2 to 3% of the single-family rental stock nationally. So if the emergence of institutional scale landlords can only explain a relatively small share of the overall shift towards entity ownership, how ought we to understand this change? So I'm going to suggest that in order to develop a clearer understanding of how, where, and why entity ownership has become more commonplace among residential landlords, we need to start by attending to some very basic descriptive questions. So the first question I'm going to ask today is about the relationship between entity use and landlord scale. So we know that the very largest institutional firms make up a relatively small proportion of entity ownership, but that doesn't clarify the whole picture. So should we see rising rates of entity ownership as a phenomenon driven primarily by sort of large scale investors who may not be sort of institutional financial firms? Or is it a more broad-based change that also reflects the activity of small and modestly scaled investors? The second question I'm going to ask today concerns the way in which rates of entity ownership may vary by local context, specifically by neighborhood characteristics. Are there particular market contexts in which entity ownership is more commonplace? And if so, what might those contexts suggest about the specific conditions under which entity use is particularly attractive to landlords? So to a certain extent, these were both questions that I'd already been thinking about as I was working on an earlier piece of my dissertation project, which looked at the relationship between LLC ownership and property disrepair among rental properties in Milwaukee. And Milwaukee was not a city that had really been the focus of acquisition activity by institutional investment firms. But when I looked at over 2 decades of city assessing data in Milwaukee, what I observed was the same clear uptick in entity ownership of rental properties, driven almost entirely by the growing popularity of LLC use among relatively small-scaled investors. So the figure on the left here plots relative shares of 5 different legal forms of rental housing ownership in Milwaukee. And here, direct ownership by individuals is plotted in blue, ownership by limited liability companies is plotted in orange, corporations in red, limited partnerships in green, and REO or bank-owned properties in black. And I would suggest that this figure on the left is illustrative in at least 2 ways. This is just Milwaukee data. So first, we can see a clear and noticeable shift towards LLC use among Milwaukee landlords, beginning not in the aftermath of the foreclosure crisis, but rather in the mid-1990s, almost immediately after the state of Wisconsin passed its first LLC statute in 1994. And second, we can see that the rise of LLC ownership in Milwaukee primarily represented a shift away from more individual ownership and not a switch between alternative business entities like the corporation or limited partnership. A second pattern that I had observed in the Milwaukee data was that LLC ownership of rental properties tended to be especially prevalent in poorer neighborhoods. So the figure on the right here plots rates of rental housing ownership by LLCs by neighborhood poverty on the x-axis for Milwaukee census tracts in 2015. And what I observed here was that in relatively low poverty neighborhoods, only about 10% of rental properties were owned by LLCs, whereas in high poverty neighborhoods, rates of LLC ownership averaged around 30%. So the picture I took away from Milwaukee was less a story about the entrance of large-scale corporations into a pre-existing market, but rather a story about how small and mid-sized local investors were increasingly turning to a newly available legal tool, the LLC, that offered investor protections that appeared to be especially valuable to landlords who operated in poorer neighborhoods where properties tended to be in poorer condition. So what are some of these protections that might make the LLC especially attractive as an ownership vehicle to residential landlords, including sort of smaller or more modestly scaled investors? So here, a little basic background is helpful. The LLC became widely available in the mid-1990s when it was sort of pitched to state legislatures as a business-friendly tool that fully integrated the attractive tax treatment of the partnership form with the attractive liability protections of sort of the traditional business corporation. And without getting too far into the weeds of business organization law here, I think it's fair to say that the LLC has had broad appeal to sort of small and modestly scaled business operators and investors for at least 4 key reasons. So first, they're easy and affordable to set up. Second, they're not typically subject to additional corporate taxes. Third, they help limit or circumscribe the liability of owner investors, protecting personal assets from business-related risks. And fourth, they can be used very effectively to anonymize property ownership. So another thing that I was really trying to puzzle out when I began this project was whether some of the patterns that I had observed in Milwaukee generalized across other major US housing markets. So to zoom out from work I'd done in Milwaukee, I turned to a national collection of assessing records assembled by Zillow as part of the Zillow Transaction and Assessment Database, often referred to as ZTRAX, for the year 2018. And here I focus on just under 8 million small rental properties that I identified within the 50 most populous US metropolitan areas. Now, because I'm interested in ownership within the private rental market, I exclude properties owned by public agencies such as housing authorities, as well as properties owned by identifiable nonprofit organizations such as churches or universities, and as well as REO properties that might be held by banks, lenders, or mortgage servicers. For the purposes of today's talk, there are really two key measures in these data that I'm going to focus on. So the first is owner legal form. So using information about the name of the property owner, I identified properties that were owned by individuals, by business entities, and here I mean specifically corporations, LLCs, or LPs, and trusts. Now, I'm not going to really spend much time on trusts today, in part because this talk is already longer than I wanted it to be, and in part because trusts are more commonly used as a tool for facilitating the intergenerational transfer of assets rather than as a tool for coordinating or carrying out business activity. And I should also be really clear here that when I'm talking about trusts, I'm mostly talking about common varieties of sort of revocable living trusts that are typically established to help avoid probate costs. These should definitely not be confused with real estate investment trusts or REITs, which are actually typically organized using business entity structures. So the second measure I'll be looking more closely at today is owner scale. So here I count the number of small properties linked to a single owner mailing address and assign each property to one of 5 landlord scale categories. So I define micro scale landlords as those who only own 1 or 2 properties, small landlords as those who own 3 to 10 properties, medium scale landlords as those who own 11 to 50 properties, large scale landlords as those who own between 50 and 1,000 properties, and institutional scale investors as those who own more than 1,000 properties. This approach to measuring investor size definitely has its limitations, and I'll definitely return to this at the end of the talk. But for now, this is the sort of operationalization that we'll go with. For tract and metro level characteristics, I rely on 2018 American Community Survey 5-year estimates. And for the material I'm going to present in just a moment, the methods are really straightforward. I'm just going to present some very basic cross tabulations at the property level to give a sense of the way entity ownership is distributed across landlords who operate at different scales. And I'm also going to look at how rates of entity ownership vary by neighborhood characteristics. And so here we can just think about these rates as a simple fraction where the numerator is the number of entity-owned properties in a given geography, in this case, census tracts, and the denominator is the total number of small rental properties. All right, so let's look at some results. So this first table just presents a simple breakdown of owner legal form in the small rental sample. And here we can see that about 70% of small rental properties are owned by individual investors. This is still the predominant form of ownership among small 1 to 4 unit rental properties. We can also see that about 20% are owned by a business entity, either an LLC, corporation, or limited partnership, a number that is reassuringly consistent with those national estimates that I presented at the beginning of the talk. And about 10% are owned by a trust or designated trustee. And we can also see that among the business entities identified here, the LLC is, by a considerable option, the preferred business entity for landlords and investors. Before we turn to the relationship between entity use and investor scale, though, I think it's worth thinking a little bit about the extent we should trust this measure of owner scale that I constructed in the assessing data. So in table 2, I compare property counts linked to the largest institutional owners in Z-Tracts with property counts reported either in SEC filings or estimates published in a 2008 market analysis conducted by Amherst Capital. And so constructing these counts for the largest owners often meant identifying connections between various subsidiary holding companies. For institutional firms that filed SEC reports, this was somewhat easier because I could actually see lists of subsidiaries. For those that didn't, it often meant trying to find connections between addresses, often through Google searching or looking at corporate documents. I find the numbers in this table to be somewhat reassuring. So if we look at the sort of first column, the left-hand column, and compare, let's say, sort of the first row, invitation homes, we can see that in the Z-Trax data, about 74,000 rental properties were linked to invitation homes. And this isn't so different from the numbers reported in their SEC filings, about 81,000, or the number identified by Amherst Capital, about 78,000. And I'll also note that that first column on the left is only for the 50 largest US metros, whereas the numbers in the second two columns reflect national counts, and I think in some cases international counts, because some of these firms do have some Canadian, did have some Canadian holdings as well. So this table sort of really gets to the heart of the issue of entity use and owner scale. So if we start with the left-hand column of table 3, this all properties column, we can see that the majority of small rental properties appear to be owned by small-scale landlords, with 87% of small rentals linked to a landlord who owns 10 or fewer properties. And down at the very bottom of this left-hand column, consistent with estimates generated by other scholars, we can also see that institutionally scaled investors own about 2% of small rental properties in the Z-Trax data. So perhaps unsurprisingly, this pattern of small-scale ownership is especially pronounced among individual landlords, who, if you recall from table 1, own about 70% of small rental properties in total. So if we look at the second column of table 3, we can see that among properties owned by individual investors, 75% are owned by a landlord who owns only 1 or 2 properties, and 94% of properties are owned by landlords who own no more than 10. Now, finally, if we look at the third column of table 3, we can see that among properties owned by business entities, limited liability companies, corporations, and limited partnerships, there's a much wider range of owner scales. So for example, here we can see that about 12% of entity-owned properties are linked to an institutionally scaled firm. But it's also the case that 57% of entity-owned properties are linked to small investors who own no more than 10 properties. So just to recap, this is the first descriptive question: what is the relationship between entity use and landlord scale? We've seen that the LLC is the preferred business entity for rental property ownership. We've seen that the largest scale institutional investors own about 2% of the total rental sample and about 12% of entity-owned rentals. And we've also seen that a majority of entity-owned properties are actually linked to landlords who own 10 or fewer properties. And over 3/4, 77% of entity-owned properties are linked to landlords who own 50 or fewer properties. So with these facts in mind for a moment, let's turn next to this question of how rates of entity ownership may vary by neighborhood characteristics. So there's a lot going on in this figure, and so I want to first just try to be really clear about what is going on in each one of these plots before trying to tell a story with these data. So for each panel here, the y-axis represents the tract level share of small rental properties owned by a business entity. And the x-axis represents a select neighborhood characteristic, also measured at the tract level. The lines in each figures are smooth curves that estimate the bivariate relationship between the select characteristic on the x-axis and the rate of entity ownership on the y-axis. Here, estimates are weighted by the number of small rental properties within a tract, though unweighted curves look fairly similar. So in each one of these figures, the black line represents the total share of small rental properties owned by a business entity, regardless of owner size. The blue line represents entity use by micro-scale investors, those who only own 1 or 2 properties. And the red line represents entity use by institutionally scaled investors. Because these figures are already quite busy, I've grouped small, medium, and large investors together for visual clarity. And these investors are represented by the yellow line. But patterns of entity use for these 3 classes of investor are quite similar, so we don't really miss much by grouping them this way. And if folks are interested, I have some extra slides at the end that sort of disaggregate these 3 groups. Okay, so let's focus first on the total rate of entity ownership, the black line in each one of these panels. So overall, we can see that entity ownership tends to be more prevalent in neighborhoods with higher poverty rates, larger shares of Black residents, and denser concentrations of renting households. And conversely, we can see that rates of entity ownership are lower in neighborhoods with higher median incomes and in neighborhoods where homes tend to be more expensive. And in general, we can see that these patterns tend to be driven primarily by the activity of small, medium, and large-scale landlords. So in pretty much every panel, the yellow line, which measures the prevalence of entity ownership by mid-sized investors, tracks quite closely with the black line at the top of each panel. So let's look next at the red line in each of these figures, which tracks the prevalence of ownership by institutional scale investors. So here a different pattern emerges, but one that's still generally consistent with previous scholarship on these firms. So in the panel on the top left, we can see that institutional investors generally avoid high poverty neighborhoods. And from the panel on the bottom right, we can see that these investors tend to be concentrated in neighborhoods that have, on average, fewer renting households, a finding that's consistent with a pattern of institutional investment in more suburban communities. And likewise, if we look at the center panel on the top row, we can see that entity ownership linked to institutional investors tends to be most common in sort of middle income neighborhoods rather than in low or high income places. So finally, let's look at the blue line in these figures, which tracks the prevalence of entity ownership among micro-scaled investors. So once again, a fairly distinctive pattern of use emerges. So looking at the second two panels in the top row of this figure, we can see that among the very smallest investors, entity use tends to be more common in high-income neighborhoods where homes are expensive. And looking at the third panel in the bottom row here, we can see that entity ownership among micro-scale landlords is also higher in neighborhoods where there are more renters. And so together, I'd suggest this is sort of a pattern where entity ownership by micro-scale landlords may be more commonplace in sort of expensive urban cores. So stepping back from the second question, sort of what have we learned? Well, first, we've seen that rates of entity ownership can vary considerably at the neighborhood level. And we've seen that overall, rates of entity ownership are highest in neighborhoods with larger shares of poor or Black residents. And this pattern is driven primarily by the activity of sort of small and mid-sized investors. We've also seen that ownership by institutional investors tends to be most common in sort of more affordable middle-income suburbs. And finally, we've seen that entity ownership among the very smallest micro-scale landlords is most common in sort of high-income, high property value places. Okay, so taking another step back, what are some sort of key takeaways from all of these findings? Well, I'd suggest there are at least three. First, it's that corporate ownership structures and LLCs in particular have become increasingly commonplace among real estate investors at all scales, including among small and fairly modestly scaled investors. Second, I'd encourage folks to think about the fact that there's really no one type of corporate landlord. Patterns of entity use by micro, mid-sized, or sort of institutionally scaled investors appear quite different, at least with respect to neighborhood context. And finally, and most importantly, I would say that forms of entity ownership that offer additional protections to landlords have become most prevalent in neighborhoods where tenants may be most vulnerable and housing may be in the poorest condition. And I'll return to this third point in just a moment. So as with any study, this one certainly has its limitations. And I would say that the biggest issue for this work really has to do with the challenge of accurately measuring landlord scale among investors who rely on business entities. So of course, a single investor may have many different kinds of connections to multiple LLCs or holding companies that simply aren't apparent in the data and may not be evident by linking properties via owner addresses. Now, I presented some evidence that institutional investors had been reasonably well identified in the ZTrax data, but that definitely doesn't mean that this issue is wholly resolved. And for a failure to accurately link multiple small-scale entities could really lead to an underestimate of landlord scale. So this is something that I'm still working on in this project. Another issue which I hope to continue to address as this project develops is that I've relied for the most part on a fairly limited set of neighborhood indicators that are primarily demographic in nature. And ideally, more and better measures of market context would improve this analysis, though such measures are not always readily available at the neighborhood level. And finally, and this isn't something that I've really talked about in the paper today, in the talk today, but in the dissertation chapter, I explore more broadly. None of the analyses I've conducted so far really provide clear explanations for metro level variation in rates of entity ownership. If this is something that people are interested in, I'm happy to talk a little bit more about it during the Q&A. I'd certainly welcome thoughts. So finally, some sort of top level implications, potential implications for this work. So first, I think some of what we're seeing here is the way in which the LLC may be operating as sort of what we can think of as a really poorly underwritten insurance stopgap for landlords operating in neighborhoods where the housing stock may be older and in poor condition. And I think this issue may be particularly acute with respect to liability concerns regarding lead paint hazards, which are often not covered by liability insurance policies. So absent adequate liability insurance coverage, landlords may see LLC formation as a mechanism for protecting themselves from potentially costly litigation. So insofar as this is something that the data are reflecting, one of the most straightforward things that we can do to address this issue is simply to make more public money available for costly lead remediation efforts. And so, for example, the Build Back Better Act, which is now stalled, contained about $5 billion that was set aside for lead paint remediation. I think this would be a really important investment that we could make. But I'll also just suggest that I think there is room to think critically here about how we can make sure that in cases where tenants have been harmed by unsafe housing conditions, landlords are held accountable and victims are adequately compensated. And actually, there was a great New York Times article that came out just a couple of days ago. Some of you may have seen this on this particular issue. Second, I'll also say that simply making property ownership more transparent could do a lot of good. So business entities can make it really difficult to know who the beneficial owners of a property are. And for some owners, this is a major selling point. And while an investor's desire for privacy may be understandable, ownership anonymity can also enable predatory or even criminal practices. And so knowing more precisely who owns what in real estate markets can help support code enforcement efforts, enable law enforcement agencies to more readily identify instances of money laundering, support tenant organizing efforts directed at particularly abusive or extractive landlords, and of course, enable more accurate research on evolving patterns of property ownership. And finally, I'll just conclude with a call for future research. I think there remains a real need for more research on small-scale landlords who own the overwhelming majority of small rental properties. And as the work I presented here suggests, small owners are neither homogeneous nor static. And I think that exploring the characteristics, practices, and motivations of these owners in greater depth and detail remains a really important task for housing researchers of all disciplines. So on that note, I'm going to stop sharing my screen and turn it back over to David. Thanks for your attention, and I welcome your questions and comments. Oh, David, I think you're still muted.
There we go. This is terrific, terrific work. And we have, as I suspected, a wealth of questions. Let me start. I already have about 10 written down here, but I do want to give our attendees a chance to weigh in. There are a couple of two kind of clarifying questions that you touched on, which really are about research methodology, which is, how do you know that a property is a rental property? And the particularly if you're looking at single family homes. And the second is, I think you touched on this, but I think people want to know a little bit more. How did you link ownership where each LLC might have a different name? Can you talk a little bit about the research strategy there?
Yeah, these are both great questions. So first, rental properties. So I'm using the Z-Trax data here, which do contain a measure of owner occupancy. And as far as I understand the data, Zillow sort of has two ways of inferring owner occupancy in the data. One, some jurisdictions offer sort of residential exemptions for folks who are sort of full-time residents. And insofar as those data are available, they'll use that to generate their owner occupancy code. And then sometimes they'll also infer owner occupancy where the owner's address exactly matches the property address. Now, this is an imperfect measure for identifying rental properties. I'll be the first to admit it. And so one of the things that I do in the paper that I didn't talk about here is that I try to get a sense of how these rental unit counts among small properties compare to what we might think of as more reliable counts generated by the American Community Survey. And the answer is decently, but with considerable variation across metros in ways that we might understand. And often this will reflect places, for example, where there may be a large number of sort of vacant or abandoned units, or perhaps a large number of second homes, vacation homes that may not be coded as owner occupied, but might not fall into the category of rental properties. So one of the things that I do as sort of a sensitivity check is that I omit metro areas where my estimates of rental unit counts are quite poor, to see if I'm just focusing on the metros where I really do have strong, what I think are quite reliable counts of rental units, do these results obtain? And the answer is yes. But it's a really good question and is definitely a challenge when working with administrative data. The second question was about LLC entity use when folks may have sort of serious structures with entities that use a lot of different names. This is a great question. So I'm focusing on owner address. This is imperfect. If an owner has set up a sort of series LLC structure where all of their LLCs that they're using to hold properties are linked to the same address, then this approach would accurately identify all of those different LLCs as one owner. Now, sometimes this is exactly what you observe in the data, but it's certainly not always this simple. And that's why I do think that measurement error is a major issue for anyone who's trying to link ownership across entities. And I'll also just add that there have been some really cool efforts recently by both researchers and activists to try to link ownership records to sort of corporations filings. Victor Book, which is a project, I think in the Bay Area or maybe in California more broadly, looking at sort of landlord practices there, has done this. There's some research by a graduate student at Princeton, Henry Gamori, who did this in Boston. And I think these efforts are really important and valuable. The tricky thing is that corporations filings don't always themselves contain complete information about who owns an LLC. And so this is a real challenge, and I think a space where more transparency is essential for better research.
A related question on LLCs. Are you able to distinguish in your LLC data between David Luberoff setting up an LLC versus something that actually is a sort of larger entity, a real estate developer setting up a firm setting up an LLC?
So, I presented some of those figures looking at institutionally scaled investors. And the way I generated those counts, this was sort of table 2 in the slides, is I did have to link a lot of disparate LLC or LP entities together in order to generate these counts for institutionally scaled investors. It's hard in sort of a single year cross section to get a sense of, this property is now owned by an LLC. Is this a sort of large scale investor or the previous owner who just formed an LLC and put the property in it? I would say that what I observed in Milwaukee is that both of those things are happening. Figuring out which it is can definitely be a challenge.
There's been a bunch of conversation commentary in the Q&A on why LLCs are more common in lower income neighborhoods. And the suggestion was more investors, fewer homeowners turned landlords, more lead paint lawsuits, and lower profit margins in higher rent neighborhoods. I know this is probably not something the data can answer, but I'm just wondering if you've got a sense as to why you see that pattern.
Yeah, it's a great question. And I think one that's answered less in this particular study than in past work that I had done on LLCs, this sort of Milwaukee project that I talked a little bit about. For people who are interested, there's a paper that's been published on that study in the American Sociological Review that sort of gets into these issues in greater depth. I think there are a lot of reasons, but I think the simplest one is that I think for a lot of investors, they see operating in these neighborhoods as being higher risk, and that in order to generate margins that are acceptable to them, sometimes, it requires a more of a property milking approach that generates its own forms of risk. And so the LLC is a way of sort of circumscribing some of that risk. I do think that the lead exposure issue is a really big one here. And I mentioned at the end of the talk, not having sort of good explanations yet for sort of state or metro level variation. Something that's sort of on my to-do list is to look at variation in sort of lead lead paint liability rules and how those vary across states to see whether that actually might explain some of the variation in LLC use that I'm observing in the data. But I haven't done that work yet, so I don't know.
That actually, there's two different questions that you just teed up that I'm interested in. Let me start with just the liability issue. My memory of that earlier paper was that you found a fairly strong correlation between LLCs and code violations. This was only in Milwaukee. And I'm just wondering, I suspect you haven't gotten a chance yet to see if that holds in the other 39 metros that you're studying, but just wondering if you had, or if that.
Yeah, so, code violation data is its own mess and is much less sort of widely available than property assessing records are. That is what I found in Milwaukee, that LLC-owned properties were both more concentrated concentrated within more dilapidated properties. LLC ownership was more concentrated among dilapidated properties, but also properties tended to deteriorate faster when owned by LLC landlords. I haven't really had a chance to explore this issue with national data, although I will say that I observed some overlapping trends in Boston, where I'm doing some work now, but that's all very preliminary. So yeah, short answer is TBD.
But you have a hypothesis. And the other is to tee up your metro question, which you referenced. Can you talk a little bit about what you've seen in the variation between metros and what you sort of trust?
If I can share my screen again briefly. So this slide here looks at rates of entity ownership by metro area. And here, for visual clarity, I've just broken this down into institutional owners and non-institutional owners. And so again, consistent with research elsewhere, we can see that institutional owners are quite present in select markets, places like Atlanta, Charlotte, Phoenix. We really see the presence of these folks, but it's not the whole story. And there's real variation here across metros, which I just really haven't been able to explain. You do see down at the bottom end, a lot of the metros with lower rates of entity ownership are concentrated in California. California does have some of the highest LLC formation and annual fees in the country. But the California real estate market is very complicated for a bunch of other reasons. And so it's hard for me to know at this point sort of what might be driving those lower shares down there. But again, this is, folks look at this figure and are like, oh, of course, I know exactly what's going on here. Please write to me. I'd love to hear from you.
Yeah, I was just, it's funny, I was just looking at that going, is there some variation, like you got Cleveland out on the far side, which doesn't have as hot a real estate market. Another question that just came up, that's sort of a clarifying question. You had shown a slide very early on showing the rise of any form of corporate ownership in terms of sheer numbers. And the question was, is that a rise just in the number of rental units, or have we seen a decline over that sort of 1990 to 2018 period in the number of individual owners?
That's a really great question, and the answer to it varies a little bit depending on what market you're looking at and at what particular time period. I will say that in Milwaukee, the figure that I showed at the beginning of the talk, you see a fairly steady level with a slight decline in the total number of rental units in these properties, but it's fairly stable. But that's not necessarily true everywhere, and so it's a little bit hard to disaggregate. But that's a great question.
It's interesting because somebody said, given all of the reasons why you would go to an LLC, why, at least in your argument, and there is a question of, it was more of a comment somebody posted saying that they followed the LLC advice and thought it was terrible advice, but why does 70% of owners still are individual owners, have not taken advantage of this thing that sounds like what you're,
So I'm really excited by that comment because it actually resonates for me. And I think, one thing that I did for this as sort of a piece of my dissertation was I sort of read and coded a whole bunch of landlord guidebooks sort of focused on smaller investors sort of giving advice. And LLCs were talked about widely in these materials. But I often felt like they were being sort of marketed to folks who might not necessarily need them. And so, there's a great paper by Phil Garboden called The sort of Culture of Amateur Real Estate Investing, where he sort of interviews a whole bunch of sort of relatively small scale investors and sort of looks at how they're being advised and who they're being advised by. And the answer is not always that well. And so, there are people who make money off of forming these entities or helping people form these entities. And there's a whole sort of cottage industry around it. So I would definitely say that forming an LLC is not necessarily in the best interests of all investors. And for many sort of small scale owners, I'm sure that they feel, perfectly happy carrying on as they have for a long time. They feel like they've got, whatever liability protection they need in the form of insurance that they're purchasing, and are happy to just continue to own their properties directly in their own names. And that's not at all surprising to me.
Adam, this is somewhat more speculative, although I suspect you've toyed with it, which is, at least in the popular accounts, the Wall Street Journal, the Washington Post has had a series of articles, including one today. Do you, if you were to rerun this data for 2021 or 2020 for 2021, and then in a couple of years in 2025, do you think it would still look the same, or do you think something's happened in the last couple of years that might have either increased the use of LLCs or particularly the increase in institutional owners?
So I'm definitely not an expert on the largest institutional landlords. My sense of what's been going on with those investors in recent years is sort of two things. First, there's been a lot of consolidation among firms. I think Desiree Fields talked about this in her presentation last week. So firms have sort of been consolidating within this sort of echelon of sort of large scale sort of finance-backed firms. There was a sort of spate of early acquisition following the foreclosure crisis when these firms snapped up huge volumes of properties. And then it was my sense that sort of acquisition activity plateaued a bit. So there was some turnover. They jettisoned portions of their portfolios that weren't performing, acquired more properties in other places, and that acquisition activity was continuing to proceed, but at a slower pace than it was in the early years immediately following the foreclosure crisis.
Although I don't know if I was struck, the Post article of a couple months ago was that one in seven, at least single family homes bought in the last year, they claimed were institutional. And my question was, were those institutional investors or were those LLCs?
Well, I think that is.
I don't know if you know.
Yeah, and I think that's a question that's often sort of poorly specified when people are sort of talking about corporate investors. And I think it's a good question to ask. I would also say, though, that there's research that focuses on some of these metros where these large-scale institutional investors have focused their acquisition activity. You really do see very high rates of institutional ownership in select neighborhoods. So Suzanne Charles has a great paper just focused on Atlanta. And in that paper, she really shows that in some neighborhoods, sort of rates of institutional ownership were way higher than the numbers that I'm talking about here. And it really is the case, as far as I understand it, that these sort of super large scale firms have concentrated their activity in select markets. But if we want to look more broadly at what's going on nationally, they're still a fairly small part of the overall story.
An interesting question about the rise of these kind of you can buy a share of a rental property company. I'm going to leave it open-ended. You've probably followed this. What is striking you about that activity, or is it too small scale to know at this point?
That's a great question. I don't feel equipped to answer it. It's sort of like on my list of like things I'd like to know more about. I've seen these sort of companies' opportunities advertised both in the US and abroad. And I think it's sort of definitely an interesting model that I just don't know how prevalent it is and how these sort of organizations are structured. But it's a great question and one I'd like to learn more about.
You had referenced in the sort of things worth looking at that, if I recall correctly, you wanted to know a little bit more about the real estate markets where these are common. And I'm just wondering if you've got a couple, either a working hypothesis or what would be, how would you frame that question?
Yeah, so a few of the things that I'd like to know more about at the neighborhood level So unfortunately, the assessing data you'd think would have really great information, really complete information about property age. They're sort of mixed in that regard. And if lead really is a big part of this story, I'd like to look more carefully at sort of building age as a key predictor of LLC use. Certainly, there have been some past findings that have shown that institutional scale investors really reluctant to touch properties built before 1978. They don't want to buy them. Too many problems. It's just not worth it. And so at the metro level, cities with higher portions of sort of pre-1978 stock tend to be avoided by these investors. I'd like to look at this more carefully at the local level, as well as just things sort of like home price indices calculated at a very local level, vacancy rates calculated at a very local level. Some of this information is available in the ACS, although tract level estimates for these sorts of things tend to be quite poor. So
this is I'm just scanning through some of the questions here. There's a marvelously open-ended question, but again, it relates and it connects to some of the conversation that from Desiree Field's presentation, which is available on our website for those of you who didn't see it, and I commend it to you, which is from the point of view of the renter, do we know anything about the difference in quality of life, whether their units are owned by an institutional investor, an LLC, or an individual? And I guess I'd add to that there is a narrative out there that these large institutional investors, some people are claiming are really squeezing their tenants, both in terms of not being particularly kind if people fall behind, but also not necessarily doing the repairs. Again, I think I know you don't know the answer to this, but again, I'm wondering what you're seeing.
My data definitely don't speak to that question directly, but there is definitely research that has found, a variety of patterns of potentially harmful practices for tenants, both when you just look at the largest scale institutional investors and as well as studies that just sort of look generally at any form of corporate owner. So I'll just say, like, there's a growing body of empirical research that will just say, okay, we're going to look at whether or not sort of corporate ownership predicts X. And I've done some of this work too, without necessarily sort of disaggregating corporate ownership by size. And so those studies suggest that there are different patterns of activity among corporate investors, although it's not always clear what size of investor they're talking about.
Have you done any work? There are a couple questions here related to the structure of housing finance, the way Fannie and Freddie look at this, and wondering if that's something you've delved into, or again, were you to go in, what would be sort of the way to think about that?
So I will say that if you are somebody who wants to set up a set of limited liability companies or a limited liability company to limit your personal liability, if you're reliant on sort of traditional financing to purchase your investment properties, things can get complicated because banks often won't lend to an LLC. They want an individual sort of signing the mortgage documents and on the hook for the debt obligations. And so that's not always the case. If the business has an established credit history, things might look different, but it's often the case. And so I haven't looked into this. I would expect that cash purchases are far more common among LLC buyers than not, but my data don't directly speak to that.
And a couple of interesting questions about whether you've looked at whether any of these forms of corporate ownership are more common in areas that have any form of rent regulation. And I guess now that both California and Oregon have some statewide measures that might be interesting to measure. And I'm going to add on to that, take moderator's prerogative and say, and this goes back to your housing market characteristics. Have you tried to link any of these ownership structures to the metros where rents have been rising particularly dramatically? We've been in our most recent rental housing report, rents rose dramatically in pretty much across the country, but in some metros it was particularly extraordinary.
So I don't look at that in my data. There are some analyses that have looked at metro level shares with respect to just the largest institutional firms. And in these studies, this particular paper I'm thinking of did find, I think they looked at home price indices, and they found that institutional investors tended to be concentrated in places with sort of stronger home price growth. Now, whether or not that was because of the presence of these investors, or simply that they sort of happen to gravitate to these already high-performing markets is open, I think, for debate. But I don't know of anything that looked at that with respect to rent prices. It's an interesting question. I don't know. Yeah.
I find myself curious, as you've gone through this research, is there anything that's really particularly surprised you in terms of your findings? Either maybe something was even bigger than you thought, or something didn't come out the way you were thinking about it?
Yeah, that's a great question. I think something that I'm still trying to puzzle about a little bit in these data are these sort of like micro scale owners, these folks who, despite only owning sort of 1 or 2 properties, as far as I can tell, still have opted to sort of set up an LLC and pop a property in it. And it may be that these are just sort of like the vacation homes or pied-à-terres of the sort of wealthy elite. There's been some sort of commentary written on the way sort of these tools can also be used to sort of facilitate money laundering among sort of high net worth individuals. So I'm curious sort of to try to think a little bit more about what's going on there. I do think there's something different that indicator is tracking, but I don't know that I have a clear story yet for what it is.
And my last question, and this will be proof that I've been listening to lots of Ezra Klein podcasts, as like everybody else in the world, I've been trying to understand what the heck is going on in the Ukraine, et cetera. And you've referenced a couple of these, but for people who are delving into this, and I should note that at some point later this spring, Adam will be publishing a version of the paper that he's been describing in this talk as a Joint Center working paper. Subscribe to our blog so you'll know when that comes out. There'll be a blog that will go with that paper. But I'm going to put your LLC paper, earlier paper aside, which I really commend to folks. What are we'll do the Ezra Klein. What are 3 things that you would recommend people read if they want to know more about the sort of general set of topics we've been discussing?
Yeah, it's a great question. Only 3, so difficult. So, okay, I think I'll just sort of think.
Well, since I'm not Ezra Klein, if you want to do 4 or 5, go right ahead.
I think I'll just sort of broadly answer that with respect to sort of material on landlords generally. So 2 sort of historical books that I think are really terrific and must read are Race for Profit by the Princeton historian Keeanga Yamada Taylor, which really develops this notion of predatory inclusion, which I think is a really helpful concept in thinking about ways in which predatory behavior continues to persist in highly racialized housing markets, even after sort of efforts to formally break down what we might think of as more traditional redlining. So that's a terrific book that I would strongly recommend. The historian Beryl Satter has a book called Family Properties, which I think is a really interesting look at sort of the prevalence of predatory investment strategies in Chicago, sort of mid-century Chicago. And you actually see there some of the predecessors to LLCs and some of the earlier entities that were used by the sort of most bad faith actor investors to sort of hide their behavior and limit liability. So those are 2 books that I would highly recommend. I also really enjoyed Eva Rosen's recent book, The Voucher Promise. It's mostly a book about housing choice vouchers or Section 8 vouchers, but there's a good chunk of material in there about landlords, which I think will be of interest to folks. And I also recommended Phil Garbodin's paper, sort of the culture of amateur real estate investing, that was recently published. I can't remember what journal that was in, but I think it's a great read and also very informative. And also sort of looking back at past Joint Center stuff, it may be a little dated now, but just thinking about small landlords in particular, Alan Malik has a 2007 sort of Joint Center working paper on sort of small landlords. He says they were understudied then. I think they're still understudied now, but it is sort of an interesting look back. There's a lot of cool material there.
And I will note that Elijah De La Campa has published a couple of things recently about the experience, particularly of small landlords during the pandemic, which we didn't really touch on, but your data is of course pre-pandemic. Well, we've got lots more questions, but no more time. And just sitting here, this is wonderful, wonderful work. One of the goals of the Joint Center, if you read our mission statement, which we take seriously, is to encourage young scholars and graduate students who are thinking of careers, within the housing field. And the Meyer Dissertation Fellowship is a real centerpiece of that, and it gives us a chance to provide some support for scholars from a variety of fields, and who are really doing interesting new research. As I mentioned in my introduction, Adam first came to us through a different grant program, and did fascinating work, and then subsequently was a Meyer Fellow. And this presentation, this work, to me, is exactly what we're hoping for. I think you've done a really important look at something it happens is getting attention long after, well after you started some of this work, and unpacking it in really interesting ways that are making a lot of us sort of go back and think about what we did. So terrific piece of work, terrific presentation, really appreciate it, and look forward to reading the full paper and following your career for some time to come. Thank you very much, Adam.
Great. Well, thanks, David, and to everyone at the Joint Center, much appreciated.
Okay, we'll see everybody hopefully in a week for Erica Mostakowski's talk on retail vacancies. Everybody have a great day. See you later.